Alright, I'm back again, and today we're going to talk about some ETFs. I don't really get into ETFs because right now ETF has its own reasons and its own purpose, and personally I just don't want to pay fees to own an ETF. Whenever I can just click on them and see what they purchase and hold the same stocks. So my personal preference. Now, I do have some of these ETFs, but they're in retirement accounts where I don't self-manage my own retirement account, and this is where I put them. Now, if I had to pick one ETF and put money into it, because having multiple ETFs at different rates, it is a good thing, and you should do it. But if I had to choose one over other, we're going to go over SCHD, which is a very popular ETF. We're going to go over JP Morgan ETF and a new one called Amplify CW Enhancement. These are very popular ETF, and if you're going to run your own portfolio, you're going to run your own stock information, you can purchase these. There's nothing wrong with them. These are all great stocks. That's for the foremost is what I want to say. These stocks are very good stocks, and I do recommend purchasing on them if you're a beginner stock investor. Now, these, I believe ETFs has a purpose. I just don't like paying an expense ratio of 0.56%, 0.35%, and this is 0.06%. So if I'm going to start comparing these ETF, which one is better, the very first thing I do is I'm going to say right now, so everyone don't waste their time, SCHD is the better one because they have the best growth over the year. They have over a 3-year, they had the best growth, and over the 5-year, they had the best growth. So they had the best growth. They had the best on the expense ratio. They're the lowest. So if any one of these are gonna weigh over the other one, it's gonna be SCHD. Now, I'm not gonna say you shouldn't add all three to your portfolio because they do own different part of the sector, and you can use this to diversify. Now, I don't recommend you, if you're going to build a portfolio, to do ETFs and stocks in your portfolio because it's kind of counterproductive because these stocks own a bunch of companies' stocks. So you can see what they're holding, and they are holding, well, this one is DIVO, and it's holding Apple, it's holding Caterpillar, it's holding Home Depot. So if you are looking to build a dividend portfolio, you can just copy what they do. Pick the ones you like and have, the greatest return for them. And you can do this same thing for each one of these companies. So JEPI, they own MasterCard, Microsoft, and you start seeing a lot of these companies have overlays on what they own. So that's why I don't like owning companies like ETFs in a stock portfolio, because a stock portfolio is supposed to be more for individual. Now, if you're new to it and you don't pay attention to stock, ETF is a great route. So let's compare to really which one is the better one. So in my personal belief, before I go into any more detail, SCHD is the better one. They have a return of 21% over the year. 3 years they had a 11%, and 5-year they had a 56%. And if you want to compare it to all the other ones, you can see that this had 11% negative in the 3 years and 18% for the 5 years. And if we go off of, hey, what are you trying to do? Hey, this DIVO pay monthly. They pay a 4.6 or 4.46% dividend yield a year, compared to, let's see what their dividend yield is 7.17%. So JEPI pays a higher dividend yield per year, and they also pay monthly, and they have a cheaper expense ratio. Now, if you're trying to diversify in your ETF, this is a company that you should buy too if you're trying to diversify. But if you only had to pick one and it's a monthly income, well, this one has a higher dividend yield and it has a cheaper expense ratio. Why would you go to another company and pay more money for a ETF if you had to pick one? Now, like I said, these ETFs, if you are not going to look at your stocks all the time, you're not an experienced day or an investor, so you purchase ETFs to allow the professional to do the work for you. Now, if you're always on the stock market researching and then purchase one of these, it should be shame on you. You're paying someone an expense ratio for what you are currently doing on your time too. Because why are you paying a expense ratio, especially a high one of a 0.56%, for them to do the same thing you're doing, looking at stocks and comparing what do you want to add to your portfolio, which one you should sell. And if you're already doing that, you shouldn't be purchasing these ETFs. Now, I can go more in detail, which each one of them does, but they all pretty much do the same thing. They look for things with high returns, and they try to sell option and puts to make up money so they can make a profit for you better than the stock market. And personally, if I'm going to pick anything, it's going to be SCHD for the win, because they have a low expense ratio. Either you can't get away from paying these expense ratio if you purchase them. That is the thing. So if you're going to have to pay the expense ratio, you want to keep your expense ratio as low as you can. There's some that are 1, there's some that's 2, some of them can even be as high as 4 or 5%. And when you start calculating with larger amount of money, this percentage will cause you to lose money. And it's not losing money, it's you're paying them to manage your portfolio. So if you're going to pay them to manage your portfolio, you want this as low as you can. Now, the other thing is, what are you needing it for? If you're looking for a monthly income, then yes, you want to go with JEPI, because it has a higher dividend yield and it has a expense ratio of 0.35%. If you want to compare it to this one has a 0.456% DIVO for the expense ratio, and they have a 4.46 dividend yield, and they pay monthly. Now, that is a really good dividend yield. That's a high dividend yield, and it is good to have in your portfolio. But if you had to pick one and you want to get paid monthly, I would go with the lower expense ratio and the higher dividend yield, because at the end of the day, if you add this 7.17 back into it, or this 3.48, if you go to year to date, 21 plus 3.48, you're going to have 25% year to date. And then if you do the same thing with this one, year to date, 11.97 plus 7.17 will give you a 19% return. Because, yeah, it'll give you a 19% year return. If you go to this 1 year mark, you get a 19.88 plus 4.46. So the growth on this one is better than JEPI. But you're looking to get paid more every month. This is where you need to look at. This one will pay you more each month, but this one has a better growth opportunity. And if you look at the charts for these, like, let's look at this chart. From 2011 to 2024, if you follow this line and then you go to this one, you go to max, they all have a positive trend. You go to the 5-year, they look very similar at this 5-year mark, with the same dip, with the same up and down. So they pretty much react the same with each other, because they probably have a bunch of the same stocks, or they have close to the same stocks in each of their portfolio. So they're going to act the same on the stock market. The thing is, how much money do they make on the option inputs? And I'm not a very big person that wants to deal with option inputs. This is another reason why I don't deal with DIVO, because they could have a bad month on that option strategy and cause it to go south. I'm pretty sure they have AI looking at it, and yeah, they have it where they don't lose money. Now, that's just my opinion on these 3 stocks. They're great stocks, all 3 of them, but at the end of the day, if you had to pick one, I would do it the Charles Schwab. Has a better overall return of everything and lowest expense ratio compared to DIVO. Now, DIVO is still not a bad stock. Don't get me wrong with these other 2. Personally, if I had a portfolio and wanted to just build an ETF portfolio, I'll put all 3 of this with also QQQ. And I would split it evenly between all 4 of them, because all 4 of these are really great ETF companies, and they all pay, the expense ratio and dividend yield is all, it pays very high. So if you're looking for a good dividend stock with a good growth, these are really good ones, and there's nothing wrong. But I think the king out of all of them is the Charles Schwab SCHD. Thanks for watching the video. You agree or don't agree, comment down below about it. But I believe if you're going to put all your money into one ETF, this is the one. The other ones are kind of don't get as good growth opportunity, and their expense ratio are higher. Is the reason why I wouldn't purchase them over Charles Schwab. Thanks for watching. Stay tuned for the next video.